Welcome to the True Wealth Investors Real Estate Podcast. Creative investing strategies to help you build true wealth. I'm your host, Chad Harris. All right, so with private money, five benefits of private money. Number one, and this is going to be key for you guys because I know two of you talked about this being an issue, is if we fund deals with money from a private lender, we don't have to have money down. So most of my deals, the private lender funded everything. Okay, so the private lender will fund the purchase and fund the rehab as long as the investment, the loan they're making, is less than 70% of the after repair value of the house. Okay. So
Can you say that one more time?
yeah. So the key is number one, no money down. The formula is their total loan, purchase and rehab, has to be less than 70% of the ARV of the house. The ARV is after repair value. Okay, so as a quick example, let's say we have a house that once it's fixed up, it's going to be worth 100,000. We find it and we can purchase it for 50, but we're going to need to put 20,000 into it, right? So we're going to put 70,000 into it, but then it's going to be worth 100. Because that house is going to be worth 100, we can raise the money from a private lender for the full 70. We don't need any of our own money. All right. Now that if we try to do that with other funding, if we try to do that with a bank, obviously that's not going to work. Banks usually not even really going to want to fund the distressed property. If we try to use a hard money lender, not only is it going to be really expensive, but they're going to want us to have skin in the game and have money for the rehab and money in the purchase. So that won't work either. We can only do this with seller financing or private money. So, but that's the key, using the 70% rule. If you and your private lender, if your private lender is content lending up to 75% of the value of the home, then you can alter that figure a little bit. But I would never go over 75%. All right. Okay, number two. The second benefit is there is no credit check, which is, sometimes that's beneficial if you have a ding on your credit, right? But otherwise, it just makes the process easier. So if there's some reason you're not bankable with a bank, those restrictions aren't with private money lenders. But even if you have an 800 credit score and have no issues, it is still just a lot nicer to not have the credit score and turning in pay stubs or tax returns or whatever else a traditional lender is going to require. So in purchasing 80 doors, nobody's ever run my credit. Nobody's ever asked for tax returns, anything like that. And I've been self-employed that whole time. So that really is beneficial. If you're a contractor and don't quite fit, right, what the bank's looking for, private money lender, really, it doesn't matter to them near as much because usually they know you, they know your character. Bank, they're just looking at numbers on a spreadsheet. Okay. So that's number two. Number three, benefit of private money is there are no points. There's no origination fees on the loan. And immediately, obviously, that makes the financing cheaper, right? If it's a $100,000 loan and we don't have the origination costs of the loan, let's say of 3%, then obviously that financing costs $3,000 less than it would have with another lender. There was another REIA I was listening to. They were talking about a lender who had low interest rates, but 4%, 4 points of origination fees. So those origination fees can add up quickly, right? But with a private lender, there's no origination fees. We create the loan, not the lender. And so we do that as just part of creating the note and the mortgage deed. Now, the reason that gets really beneficial is, let's say we're doing the BRRRR strategy and we originate one loan with a lender for the purchase, and then we refinance and maybe we do another private lender, right? Or if we're going to do multiple flips and we originate the loan, do the flip, pay the lender back, originate the loan, do the flip, pay the lender back. If you look over 1 year or 3 years or 5 years, the impact of having no fees for originating that loan, that is a huge benefit, right? And in the instance that, let's say, a private lender wants paid back, if you ever look at, and this is in real estate discussions all the time, how much lower should interest rates go before I refinance? What's the cost of that refinance, right? And a lot of people are talking about that now because they're thinking interest rates are starting to tick down, and how low do they need to go to refinance? Well, with private money, there's no cost for a refinance. If you have one lender at 8% and you find another lender who will lend at 6%, there's no cost at all. You just refinance and pay off the first lender, right? It adds a lot of flexibility. And over time, that is a massive benefit financially. All right, number four. Number four benefit of private money is you're able to close very quickly. All right. And it's kind of obvious that if you have access to money and you can close within a week, let's say, which is very easy with a private money lender, then you're going to be able to get deals other people can't get. So in my normal presentation on private money, I talk about a 3-unit south of town where it was listed on Facebook right around Christmas, and the seller wanted to close before New Year's so that the sale was on that year's taxes. And so everybody saw it, right? It's on Facebook. The whole world could see it, but only I could close in that short amount of time because we could submit it to the title company, get the paperwork started, and my lender, I just emailed my lender and say, I have a deal. Are you interested in funding it? And they forward the money. That's it. That's as simple as it is. All right. So additionally, with the quick close, that actually frees up a whole bunch of other deals too. So if a lot of deals, at least in the last year or so, have been going through wholesalers. So a wholesaler finds that seller, they get the house under contract, and then they market that contract. It never goes to the MLS or never gets listed with the realtor. And if we're relying on bank financing, the wholesaler is not going to wait for a bank to finance it, right? You either have to have the cash on hand or have to have some other kind of quick lender. And so private money fits that. So you can get good deals from a wholesaler or direct to seller, either one. Any questions on any of those? I know I'm kind of rolling through them fast, but stop me if you have a question. All right, and then the number five benefit of private money is, interestingly, a lot of people, a fear they have with private money is that they will have to ask someone for money, right? A lot of people, when they think about raising money, they think that would be great, but I don't want to go ask other people for money. And that's one of the major obstacles that people have to overcome. And so the fifth benefit is, in actuality, if you raise private money the right way, you will have a whole bunch of raving fans for your business. People will be very excited. So Case in point, when I first got started and was starting my business, I was raising money from all kinds of people, right? That was my top objective, was raising money so that I could buy deals. And the way the business was set up, I did it incorrectly when I was starting. I really wasn't making much cash flow from each house. I thought my lenders wanted paid back quickly, which is another misconception. They don't really want their money paid back. They just want a good return on their money. But so I had to do a lot of deals to be able to provide for my family. So one of the guys I reached out to was my first employer. And I remembered that he had breakfast with friends once a week, asked him if he still did. He said yes. And he said, stop on by for breakfast. And so I went to the restaurant. Yeah, it was a small group of us there. But as always happens, somebody said, "Hey, Chad, what are you up to these days?" Right? And I said, "Hey, I'm really excited. I'm buying real estate. I'm buying these beat up, ugly houses and fixing them up, and I'm sharing the profits with friends and family and people I know." And most of the group said, "Oh, that's kind of interesting." Then the discussion went on, but at the end of that breakfast, my old employer said, "I'd really like to hear more about what you have going on." And so I met with him. He ended up funding 2 houses. And so now he still is one of my lenders, and I report to him every year and send him his information about his investments and what our business is doing. Sometimes I give him a call and kind of go over his numbers with him. Sometimes we show up and do it in person. And recently he invited my family over to go over his investments in person. And so my wife, 4 kids, we all went over to his house, and he had invited his daughter and granddaughters over. And so the whole gang was there, and most of the meeting was just everybody hanging around the dinner table talking, right? Just social. And then it was probably after an hour and a half, he said, "Hey, do you want to go in the other room and review those documents you brought?" So we went in the other room. His daughter came with him. I reviewed his documents and his investments, what he had already. He wanted to make sure his daughter understood his investments because he plans for those investments to be part of his legacy, right? That they'll inherit. And he asked if there were any new investments coming up, because his financial situation was changing and he was going to be looking for more investments. I said, "Yeah, definitely. Always new deals. I'll bring you some more deals." And then we went back to the kitchen, kind of wrapped up the meeting. I corralled the kids out the front door. And I'll never forget, as I was leaving, he said, "Chad, I want to thank you for these investments. They've worked out great for me. And I'm so glad I could be a part of your success." Right? So I share that because too often when we start, we fear like we're asking something of a potential lender. But in reality, we are helping them. We're giving them an investment they really want, and we're allowing them to be a part of our real estate business, which they would love to be a part of. And so I encourage you guys to definitely work on raising money from private lenders and using that as a tool to grow your business. All right. So those were the 5 benefits. 1, you don't have to have any money down. 2, there's no credit checks. 3, there's no points or loan origination fees. Number 4, we can close quickly, get great deals direct from seller or from wholesalers. And 5, we will actually create raving fans for our business. So any questions from you guys? Anything we can help you with related to private money, what we've talked about tonight, or in reality, thing with buying without banks? I'm glad to answer whatever questions you have.
Okay.
You had mentioned earlier, you were going to talk about seller financing a little bit.
Yeah, yeah. What was your question on seller financing?
We just don't really, whatever information you got would be welcome. We don't really know anything about
Okay.
it. So
So in the simplest terms, seller financing is where you tell the seller, I will pay you, for example numbers, I will pay you $100,000 for your house if I can pay you $500 a month until it's paid off, right? That is, in the simplest sense, what seller financing is.
okay,
And so when I make offers, I'm going to give them 3 offers. I'm going to give them one offer that's a really low price and it's all cash. And if they choose that offer, then they get all cash at closing. They get to move on, don't have to deal with the house, and I'm going to raise the money from a private lender. Or I could wholesale it, right? If you get a house under contract really cheaply, you can always sell that contract. The other offers I'm going to give them are a mid-range price where I give them some money down. Maybe I give them 5% down, and then I give them a monthly payment. Maybe there's interest on that monthly payment. And then the third offer is above the value of the property, a really high price, but there's no interest and it's just a monthly payment till I pay them off. And in those instances, and one of the other presentations, which I know if you go to True Wealth Investors Real Estate Podcast or truewealthinvestors.com, you can find the YouTube channel. I forget the exact name of the YouTube channel, but I go through 3 offers on a property worth 150. We can offer 100,000, 135,000, 170,000. And in the end, because we understand the cost of interest, that $170,000 offer is the best offer. So seller financing works really well with retiring landlords, right? If they're a real estate investor who they like the idea of a rental, they like getting rents and cash flow, right? That's what we've all said our end goal is, right? We want those rentals, we want the monthly cash flow coming in. But then every investor gets to a point where they still like the cash flow, but they don't like the tenants and toilets and phone calls and everything else that comes with that cash flow. And so if we offer them to buy with seller financing, then they can still get cash flow. They'll just get a little bit less, but they still get that monthly cash flow. And we, as the new owner, take over the tenants and the toilets and all the headaches.
gotcha.
So, and that's, I mean, that's just the concept of seller financing. We would need to use different documents depending on whether they have a mortgage or don't have a mortgage on the property, or exactly, there's different legal documents or structures for the purchase. But the concept is we don't pay them up front, we're going to pay them over time. So,
Okay.
and I have a bunch of videos that go through that, but I'm glad to answer other questions about it too. So,
So I have a question for Sham. Hi, Sham.
Hi,
Good to see you.
good to see you. Absolutely.
My question is, what are you eating? I have to know what you're eating. It looks good.
I think it's just some cashews and almonds.
Okay, good job. I just had to tease you, that's all.
Just a snack. Just a snack.
Yeah, I'm just teasing you.
Thank
No, I
you.
do have a couple questions. Chad, a couple times you mentioned the BRRRR strategy. What exactly is that?
Yeah, the BRRRR strategy it's an acronym. So the acronym stands for buy, renovate or remodel, rent, refinance, and repeat. So it's a great way to build a portfolio of rentals, and you really don't have to have very much money. So if you raise money, let's say from one private lender, and you purchase one property and refinance it with a bank, let's say, every 6 months, then when you refinance with a bank, you get the money back from the private lender to purchase another house. And you can just recycle that money over and over and over again. Which is exactly how I built my portfolio. There's a lot of, in recent times, the BRRRR strategy since interest rates rose, the BRRRR strategy became unpopular because it's hard to refinance at 7, 8, 9% in cash flow, right? Especially with high home prices. But if you use private money, there's a lot of benefits because your refinance could be 6% and interest only, right? You can do interest only or lower payments until those interest rates tick back down and you refinance with a bank. So there's really a lot of benefits, a lot more flexibility with the private money. But that's in the simplest terms what the BRRRR strategy is.
Gotcha, gotcha. So I have another question. So I realize that the investors, they're making interest off of the money that they would loan us. So that's their obvious benefit. But why are they willing to take so much risk as far as, you said like they don't check the credit and things like that? Why would an investor be willing to take that risk? Is it because they get to know us personally, or is there some other reason there?
Well, some of it would be that they know us personally, right? If somebody knows me and knows my track history, it's one thing if somebody out of the blue asks for me to lend them money and I don't know them at all, right? Well, then that feels risky. But let's say somebody who I know, maybe they don't have experience in real estate, but man, they're a hard worker and everything they have ever set their mind to, they eventually got it done, right? Then to me, that doesn't seem risky to lend them money, especially if I'm lending them $70,000 and the house is worth 100. It's really not risky, right? So,
Right.
the worst case scenario is, well, theoretically, the worst case scenario should be that borrower sells the house and pays back the lender, even if they don't get the rehab done. But the worst case scenario in the end would be that the lender would have to foreclose on the property. But with 70,000 invested for a $100,000 house, that's a very low loan to value.
Gotcha.
Yeah. And you said the benefit for them is interest, right? Which is true. They want the interest, but they also have the benefit of knowing that their investment is secured by real estate. So their investment isn't going to fluctuate. It's not going to rise and fall as a bear market, bull market. Who cares if they lent 100, it's worth 100. The rate of return stays the same. If they're getting 7%, it's going to be 7% the whole time. It's not going to be good years and bad years. And they get cash flow, which is hard to get in the stock market. So that's another benefit. But also, they would love to be in real estate or involved in a real estate business, right? And so that really is another benefit for them. They are now an investor in real estate, even though they don't maybe understand how to do a flip or understand how to buy a house that's not listed with a realtor or how to deal with a tenant or any of those things. That is a true benefit for them to be involved in real estate. So there's a whole bunch of benefits for them.
Gotcha.
Yeah, Travis.
Can private money lenders take advantage of those tax incentives too, in terms of like I read in a book what did it say? There are certain incentives where the income is oh no, it's in conjunction with something else. Never mind. Never mind.
Yeah,
Back.
no problem. Usually there aren't really tax benefits to be a lender, so the
No.
interest that they receive would be earned income.
Oh, it is
Now,
earned.
Yes.
yeah, that's earned income.
Okay.
Now, for a seller, if you get into seller financing, then there's a whole bunch of tax benefits for that seller to be paid over time.
Okay.
So they will have capital gains usually if they've owned that property for a long time. And so they can defer the capital gains into the future. They can split the capital gains over many years. If they do, in some instances, they can push the capital gains out past their lifetime, and then there's no capital gains tax because of the step up in basis with their kids inheriting the property. So there's a whole bunch of tax consequences with seller financing and a lot of good benefits for them. But on the lending side, there really aren't many tax benefits.
Okay.
Yeah. Good stuff.
Now
I
they
love-
can, if you own the property for any more than 2 years and you lived in the property in the last any 2 of the last 5 years,
Right.
you have no capital gains. That's one secret a lot of people don't know. When you own a home, that's the biggest advantage you have. For a single person, up to 250,000. For a married couple, it's $500,000 profit before you pay 1 penny in taxes to Uncle Sam.
Right.
And you can do it every 2 years. A lot of
Right.
people don't know that, and not many people tell them about it,
Yeah.
unfortunately.
Well, a lot of people are taking advantage of that now.
Oh, you should.
Mm-hmm. Yeah.
Anytime Uncle Sam gives you a break, take it and run.
Yeah. Yeah, they don't give you many. So when they give you
No,
one,
no.
take it.
Yeah.
For sure.
So, Chad, would you kind of consider this kind of like business on a handshake? I mean, there's no contract written up between the lender and the investor and but between the two parties.
No, so it is everything is negotiated in just a conversation, right? If we're talking to a seller or a lender. But once we come to agreement, then everything is handled exactly the same way as with a bank. So the
Okay.
closing is with a title company. The
Okay.
documents are provided by an attorney. We get title insurance. We're always going to have title insurance to make sure we can actually have title to the house. So that front end, where we're negotiating for the deal, that's all just relational in a conversation. But once we come to agreement, then it is completely contractual, recorded with the counties, handled with a title company. Everything is above board. Yeah, that's a great
Gotcha.
question.
So,
Yeah,
can you just give us an example of like a deal just from start to finish, like kind of how the whole thing works, like from start to finish? So just give us an example of how that would work from start to finish, like for you, for example.
Okay, real simple private money example. Seller reached out to me. They had a house that they lived in. It was on kind of a busy street, and they had already sold me a rental years back. Well, it wasn't really. They wanted it to be a rental, but it was a totally trashed house that they'd never fixed up. That we turned into a rental. And so she trusted me, right? We had a great relationship. And so she had gotten multiple offers from wholesalers trying to beat her down on this low price. She didn't know them, didn't trust them, called me, and I forget what the exact price that they had been telling her, but when I met with her, she said she wanted 40,000. And that was a little bit more than what the wholesalers were offering. Still a really low price, right? Small 2-bedroom house. I mean, she lived alone, but that's the amount of money she needed and felt happy with to get to the next house. So I didn't negotiate with her. I just said, yeah, perfect. 40,000. That's great. So we signed a purchase agreement and I emailed that to the title company. So the title company started the process of getting closing ready. I emailed one of my lenders, said I have this great deal. Here's the purchase price. Here's what we're going to need to do as far as a rehab. And here's what the house will be worth. So with some work, the house was worth 90,000. Updating it, painting it, putting some flooring in. Not a ton of investment, but a huge upswing in value. And so obviously that was an easy step for the lender. So with a value of 90,000, they they sent $60,000. So we were able to purchase the house and then for 40 make the rehab, and then we had additional money from that lender in case that the furnace was out or the roof was bad or some other odd thing came up in the rehab. It didn't. So we had additional money from that loan. We still make the payment to that lender every month on that house. The house was rented, fixed up in a short amount of time, rented. And so that's the deal.
So you just
Are
continue
you gonna
making that
convert that?
payment to the,
I'm sorry.
I'm
Go ahead.
sorry, go ahead, Travis.
No, go ahead.
So
So
you just continue making that payment you continue taking the rent from that house and making the payment to the lender until the loan is paid off.
okay. So we rented the property, so we continue to get the rent money.
Right?
The lender, which most private lenders actually don't prefer to be paid off, they want a return on their money, just like the stock market, right? Just like if they invest in let's say Apple stock, they just want a return from the stock. And then once it's not performing, they'll sell the stock. So we make the payment to our lender. It's interest only. The loan stays at 60,000, right? The house has gone up in value since then. And once we decide to refinance, then we'll refinance that with a bank, put it on a long-term 30-year amortization and pay them back. But we don't have to do that right away. We can just keep the interest only payments. We cash flow well, and we wait for the interest rates to go down.
So you're just paying them interest every month
Exactly. Yeah.
and that loan's sitting there
Yep.
until you're ready to refinance.
Yep.
And at what point and why would you be ready to refinance? You're going to rent this house.
Yeah. So I don't have to refinance, right? We could just keep it interest only like that, or if interest rates go down, let's say if my private lender's at 7% and suddenly I can refinance with a bank at 6%, then I would probably go ahead and refinance, pay the lender back, and then they'll lend me that money for the next deal, right?
Okay.
So once I refinance and the lender gets their money back, that's my money for the future deals, right? They like getting that return. But if I borrow money from them at 7% interest only, and I would have to refinance at 8.5% or 8%, or that just, yeah, I have a hard time rationalizing. So we'll sit. And interest only. Okay, a lot of people struggle with interest only because they think, well, I'm not paying the loan down, right? Well, for my story, what I said, I started all wrong. So I started where I tried to pay my investors off really quickly, really short amortizations. So I didn't make any cash flow. And then I learned the concept of a loan constant and realized that I was making loans that were super high risk, insanely high risk. And it was high risk for me, but it was also high risk for my lenders. And so the reverse of that is we do interest only payments. That reduces the risk for our lender and ourself. The extra cash flow I can then use for the next purchase. So I don't have to borrow 70% on the next house because I've got cash flow from this house, right? So my next loan might be 65% loan to value or 60% loan to value. And so over the portfolio, it really doesn't make any difference at all, besides lowering the risk for the borrower and lender. And then once we decide to deleverage that portfolio, then we can have 80 tenants start paying loans off. We could sell 10 properties and pay off loans on other properties, right? The key is acquiring properties. Once you acquire the properties, then you have a whole bunch of flexibility in how you manage the portfolio. So usually the hardest part is getting the properties. So interest only helps with that. Yeah, Travis.
How long is your terms that you do for your private money lenders? Because you
Private
do.
money lenders are interest only for 10 years, and then we'll extend it if they're happy with it.
Okay.
Yeah,
And you try to shoot for around 7 or 8%,
I do 6 to 8%.
6 to 8.
And it really just depends on the lender and what they feel like they could get elsewhere, right? I'm competing with CDs or mutual funds or some other annuity or, and so some of them feel like they can get 7 and so, well, I have one that I pay 8%, but most of them elsewhere, they're going to get 4 to 5% return, and I can pay them 6 to 7%, and they're happy. They're in real estate and they're getting a better return.
Chad,
So,
I have a question.
yeah.
I was just going to ask though, you talked about a couple of houses that you've kind of found through old business partners and things like that. Do you cold call people? Do you try to stay like in Ohio? So a couple of different things, like how do you find them, number one? And then also like, if you find one on the wrong side of Dayton, you probably don't purchase it necessarily, or what's your thought on that? Like where you actually buy the houses?
Yeah. So, I've done all kinds of marketing over the years. I've done bandit signs and truck signs, yard signs in our rentals. We've done direct mail, letters, direct mail, postcards, networking through other investors is always a good one. Networking through wholesalers, and we'll get leads from all different ways. So there's not really one specific way to get leads. I used to do door hangers, right? If the grass was tall, nobody's mowing the grass, I'd run up. And if nobody answered the door, put a door hanger on the screen door or put a yellow post-it note on the door with my number, something like that. So it's just being consistent of always looking for deals, always marketing for deals. As far as where to buy, that gets super complicated because it could be both ends. Maybe I don't want a rental in the southern area of 45417. Me personally, I don't want a rental there. But me personally, I generally don't want a rental in Centerville either, right? Because the cash flow is going to be minuscule. So there's a sweet spot in the middle there where you can make cash flow and the neighborhood is going to appreciate. That doesn't mean I won't buy in a 45417. But if I buy, and that's just one example zip code, right? Let's say there's any zip code I really don't want to buy in. I still might buy it, but I just won't keep it as a rental. I'll sell it on terms, right? Or I'll do something else with it. So the buy box, it gets complicated. Maybe in an A neighborhood, you don't want a single family, but maybe multifamily would work because that'll cash flow better generally. So um, I like broad marketing because then I can decide once I get the lead what to do with it. So, and it changes over time. When I started, I loved big rehabs because I was doing all the work and that made it cheap, right? Because I didn't value, I wasn't paying myself in essence. And then once I started hiring everything out with contractors, I liked smaller rehabs, right? Doing seller financing. Then I wanted occupied properties because they started cash flowing immediately. So it changes over time as to what exactly you want. And it'll be different for each person, right? Each one of us would end up with a different target deal based on whether we want to work on the property, not work on the property, want cash flow, want appreciation. All of that's going to vary. But it's a good question, Brent. I don't have a clear cut answer of this is the right area to buy in. It's going to depend more on you. Do you feel like at this? Oh, go ahead, Sean. What do you want to say?
I just want to share, based on my experience in investing and also as a real estate agent, no matter where you buy the property, no matter where, there is always someone that wants to live there, rent there. We think too much into who am I going to rent it to? Who's going to rent it here? Don't worry. People rent for a lot of reasons. Maybe they grew up there. Maybe their folks live in that area. Maybe they went to school there. Maybe they went to church there. Why do you care? You have a product just like Myers and Target. You're putting a Target on the shelf. Let the people that walk into the property choose. And you have to do your due diligence in screening the people. That's something you'd never ever shortchange. Even if they are flashing $10, $100 bills in front of you, it does not matter because it's going to cost you later more. So do your diligence as to their rental history and their income and establish some guidelines who you're going to rent to. I know we've all followed fair housing regulations, but if they don't financially qualify to rent your property, my rule was they have to make 3 times of the rent as a gross income. If they make only twice, you can reject them legally. Nothing wrong with it because you're protecting your investment. And that's been my experience, whether you buy to rent or buy to rehab. Of course, you go check out the neighborhood. If the block that you're buying a property, you got about 20 houses and 8 of them are boarded up, that's not a good area to either rent or to rehab and flip. So you just have to make a decision. You cannot say this part of town, other side of the river. You cannot say that. They go block by block. Somebody says, hey, I got a property on Hillcrest Avenue. Is it a good area? I said, tell me what block you're talking about.
Yeah.
Because it goes 4 blocks and it gets nicer. Then you go 3 more blocks, it goes worse. Then it's going to turn again. So you just have to go by the block by block, and not just the whole neighborhood. That's my experience.
Yeah. And in reality, yeah, I love that point, Sean. And also, let's say I state my buy box and my street, my blocks that I like. Somebody else could have the exact opposite buy box, right? Just because I say one zip I don't like, somebody else is doing really well in that zip code. So a lot of my clients, I tell them I love 45416. They've never looked at 16.
Yeah.
That's one I really like, right? Small houses, still a lot of homeowners. For whatever reason, that's one that I like. That does not mean everybody likes it. Anything else, that just means that I like that criteria, right? So it's more about you finding what you like.
Only one thing I want to add to that, Chad, is based on my experience. This is practical experience investing and selling. The properties in the city of Dayton are a gold mine, but you have to learn how to mine it. That's the trick. That's all.
It's good. Yeah. It,
I appreciate it.
that is good. So, yeah, we could go into a whole bunch just with that statement, Sean. But that's a good statement. So,
Good deal.
All right. Any other final question before we wrap it up this evening? I appreciate everybody's questions and I love the discussion. So, hope it was beneficial and helpful. If you have a question in between meetings, you can email me, chad@truewealthinvestors.com. I'm glad to help. I don't always respond immediately, but I am glad to help and I will respond. Sham has the third Wednesday meeting coming up here in 2 nights
Yeah.
at the GDAA offices. And then we'll have the first Wednesday, we'll be back with the main meeting. All right. There's a whole bunch of other meetings at gdria.com. All right. I appreciate you guys. Hope you have a great evening. We are adding new episodes every week, so make sure and subscribe and check out all of our content at truewealthinvestors.com.